All right, let's jump right in. It's Monday, January 13th, 2025, and man, the markets are already buzzing.
Definitely feeling the energy this week.
Feels like we're in for a wild ride,
Yeah.
with everything going on. We've got a ton of sources here pointing to some major trends.
A lot to unpack for sure.
And we're going to break it all down for you so, like, you know what to watch out for this week. Kind of like your market cheat sheet, right? Tech sector, bond yields, even some M&A action brewing. Ready to dive in?
Let's do it.
All right, so first things first. Friday saw some mixed signals, didn't it? S&P 500 up a bit, Dow looking strong, Nasdaq with a tiny gain. But then the Russell 2000 took a dip.
Yeah, it was a mixed bag for sure. A lot of uncertainty still lingering in the market, I'd say.
And then I saw this morning those pre-market indicators were pointing to potential losses, fourth day in a row.
Yeah, Dow, S&P, and Nasdaq all looking like they might open lower. Definitely something to keep an eye on.
Makes you wonder if it's time to hit the snooze button, right?
Uh-huh. Well, better to be informed.
I think so, too. So, got to ask, are those bond yields we keep hearing about the culprit here? Seems like they're impacting those tech stocks pretty hard.
Oh, absolutely. The 10-year Treasury yield hit a 14-month high. That definitely has investors a little jumpy, especially when it comes to those high-growth tech companies. It all boils down to cost of borrowing, right? Higher yields make it more expensive for companies, and suddenly those fixed income investments look a lot more appealing compared to some company promising big returns way down the line.
Makes sense. Why wait for a maybe when you can have a sure thing now, right?
Exactly.
No wonder Nvidia is taking a hit in pre-market trading. People are nervous, I think, about how higher interest rates will actually hit those growth projections.
For sure, it's a big question mark right now.
It's like a tug of war, Strong economy on one side, maybe more rate hikes coming, and on the other, investors looking for safer bets.
Yeah, it's a tricky situation to navigate for sure.
But hey, I did see Goldman Sachs is telling investors to hang tight. They're still bullish on the U.S. economy in the long run.
They have a point. Easy to get caught up in the daily ups and downs, but the fundamentals are still strong. And for long-term investors, sometimes riding out the storm is the best strategy.
And speaking of growth, we've got some major earnings reports this week. JPMorgan, Citi, Wells Fargo, and Goldman Sachs, they're all coming up.
Big week for the financial sector, definitely. And analysts are expecting some pretty strong numbers.
Now, this might sound counterintuitive, but why would rising interest rates be a good thing for banks?
Well, think about it this way. Banks make money from the difference between the interest they charge on loans and what they pay out on deposits. It's called net interest margin.
Right.
So when rates go up, that margin gets wider and their profits increase. So while others might be struggling, banks are kind of benefiting from this whole rising rate environment.
Interesting. So one company's pain is another's gain, as they say.
Exactly. It's all about perspective in the market. It's so true. But while the banks are celebrating, the tech sector is definitely feeling the squeeze. We talked about Nvidia, but there's also Palantir, Rigetti Computing. They're all taking a hit. What's your take on this tech washout?
I think it comes down to valuations. You see, these high-growth tech companies are often valued based on their future earnings, right? But as interest rates climb, those future earnings just don't look as valuable in today's terms.
So it's like investors are saying, show me the money now, not later.
Yeah, exactly. They're becoming less patient with waiting for those future payoffs. And that can trigger a shift from those growth stocks to more value-oriented investments.
The ones that offer more immediate returns.
Exactly. It's this classic market dynamic between growth and value. And right now, value is having its moment.
Makes you wonder, where will the pendulum swing next?
That's the million-dollar question. Always keeps things interesting, right?
Definitely keeps us on our toes.
That's for sure.
But that's why we're here, to help you make sense of it all. And we've got a lot more to cover, so stay with us. Absolutely. We're just getting warmed up.
Yeah.
All right, welcome back. Hope you're ready for more market mayhem because we've got a lot to dig into.
I'm buckled up and ready to go. Let's do this.
Awesome. So we've been talking about those bond yields and how they're shaking things up. But, sometimes I think we throw these financial terms around without really, understanding what they mean in real life.
Yeah, it's easy to get lost in the jargon.
Exactly. So let's break it down back to basics. What are bond yields and why should we care?
Yeah, I think a refresher would be helpful.
All right, so imagine you're lending money to the government by buying a treasury bond, right? The yield is basically the interest rate you're going to earn on that loan.
Okay, so the higher the yield, the more money you make.
Exactly. Now, when these yields go up, it means investors are demanding a higher return for lending their cash. Could be because they're worried about inflation, maybe they think the Fed's going to keep raising rates, or maybe they're just feeling a bit risk averse.
So it's like they're getting pickier with their money.
Right. They're thinking, hey, if I can get a decent return with less risk from a bond, why gamble on a stock, especially some risky tech stock?
It's like a seesaw, right? When bonds go up, stocks, especially those high growth ones, they tend to go down.
You got it. And remember that whole present value thing we talked about?
Oh.
Well, as interest rates rise, those future earnings that tech companies rely on, they just don't look as juicy in today's money.
Like those investors are saying, show me the money now.
Haha, exactly. Show me the money now, not 10 years from now. But hey, while some are running for cover, others are making bold moves. Like, did you see all those M&A deals going down?
Oh yeah, things are heating up on that front. It's like a game of high-stakes chess out there.
It really is. Mergers and acquisitions, they can be a powerful way for companies to adapt and evolve in a changing market. They can snag more market share, expand into new areas, get their hands on cutting-edge tech, or just streamline their operations to be more efficient.
Right. It's all about staying ahead of the curve.
Exactly. So let's take a closer look at some of those deals. We had NB5 acquiring Group Delta, which basically boosts their game in the infrastructure and environmental services market in Southern California.
Right. I saw that. Big move for them.
It shows a couple of things, I think. First, sustainability is becoming a big deal in infrastructure. NV5 is getting ahead of that curve. And second, we're seeing more and more consolidation in the infrastructure sector. Companies are trying to get bigger, get more expertise, to handle those massive projects.
So they're bulking up for the future.
Exactly. Future of big projects and sustainability. Then there's that merger of Rose Paving and Atlantic Southern Paving.
Yeah, what's the story there?
Well, that one's backed by Churchill Asset Management and 10X Capital Management. And it points to this trend of consolidation we're seeing in those niche industries, especially those tied to infrastructure.
It's like those smaller deals can tell us a lot about what's happening in the market.
Absolutely. It's like looking at the market under a microscope. Even those small moves can reveal some big trends. And then, of course, we have the elephant in the room, that massive Johnson & Johnson deal.
$14.6 billion. That's a lot of dough.
That's a big bet on the future of neuroscience. They're buying intracellular therapies, clearly looking to beef up their presence in the central nervous system space.
What's the strategy there, do you think?
J&J is probably eyeing all those potential breakthroughs in new therapies. This deal gives them access to some promising tech and a whole pipeline of potential treatments for those neurological conditions. It's risky, but if it pays off, it'll be huge.
It's like they're saying, we believe in the future of neuroscience.
Right, even with all this uncertainty swirling around. But hey, let's zoom out a bit. What about the global impact of all this? What happens here in the U.S. doesn't stay here.
No, definitely not. It's a global economy.
Exactly. Think of the U.S. economy as this giant engine that drives the whole global financial system. So any hiccups here, they're going to send tremors around the world, affecting capital flows, currencies, even other countries' policies.
So it's all interconnected.
Oh, absolutely. And emerging markets, they're especially vulnerable, They depend on foreign investment, and if that dries up because of rising U.S. rates, well, it can create this whole domino effect.
Yeah, that's a scary thought.
Definitely something to watch. But developed economies are feeling it too, The European Central Bank, they're dealing with similar inflation worries, trying to find that sweet spot between growth and keeping prices in check.
A delicate balancing act for sure.
You said it. And then there's China, that economic powerhouse forging its own path. They're focusing on domestic consumption, trying to smooth out those supply chain wrinkles, and making some economic adjustments. All of that has a huge ripple effect globally.
So it's like we're all connected in this giant economic web.
Yeah, it's pretty mind-boggling when you think about it. But hey, that's why we're here, right? To untangle these threads and make sense of it all.
Exactly. And speaking of making sense of things, let's shift gears and talk about a force that's transforming finance as we know it, artificial intelligence.
Now we're talking. Buckle up, because this is where things get really interesting.
Welcome back to the show. I feel like we've covered so much ground already, from those market swings to bond yields and company mergers. But now let's talk about something that's really changing the game in finance. Artificial intelligence, or AI.
Yeah, AI is definitely making waves. It's exciting and maybe a little bit intimidating all at the same time.
I remember just a few years ago, the idea of AI managing investments or predicting market trends seemed like something straight out of science fiction.
It did, didn't it? Like something from a movie.
Exactly. But now it's all about algorithms, machine learning, big data. It's like finance woke up one morning in the middle of a digital revolution.
And that revolution is driven by data. Financial markets generate so much information, stock prices, trading volumes, news, economic indicators. It's way too much for humans to handle effectively.
Right, it's overwhelming.
But AI, it thrives in that kind of environment. It can process massive amounts of data in the blink of an eye.
So it's like AI gives us this superhuman ability to make sense of the financial world, to see patterns and connections that we might miss.
That's a great way to put it. AI can analyze all that data, find those hidden patterns, and make predictions with incredible speed and accuracy.
So it's like having a crystal ball, but powered by data.
Kind of, and it's being used in so many ways in finance. Take algorithmic trading, for example.
Sure.
Those are sophisticated algorithms that execute trades automatically based on preset rules and market conditions.
So it's like having a super fast, tireless trading assistant.
Exactly. And then you have hedge funds and asset managers using machine learning to analyze those huge data sets, trying to find investment opportunities that humans might miss.
So it's like giving them a secret weapon in this super competitive world.
Yeah. Right. And AI is not just for the big players. It's trickling down to everyday investors, too. Think robo-advisors.
Oh, yeah, those platforms that give personalized financial advice.
Exactly. They use algorithms to understand your financial goals, your risk tolerance, your preferences, and then they recommend a portfolio tailored to your needs.
It's like having your own personal financial advisor, but available 24/7.
Yeah, right in your pocket. But of course, there are still questions about trust and transparency. Can you really trust an algorithm with your money?
Yeah, that's a big one. It feels a little unsettling, handing over control to some computer program.
I get it. That's why transparency is so important in this space. We need to be able to understand how these algorithms work, why they make certain decisions. And of course, regulations need to keep up with all this innovation to protect investors.
It's like we're exploring this new frontier, this uncharted territory. We need to be excited, but also cautious.
Exactly. And that's where humans still play a crucial role. AI is an incredible tool, but it's not a replacement for human judgment and experience. It's about finding that balance, that synergy between human and artificial intelligence.
Like a partnership working together.
I like that. So for our listeners who are intrigued by all this and want to learn more, where should they start?
That's a great question. There's so much information out there. Maybe some beginner-friendly courses or articles?
Definitely. There are tons of resources available, both online and offline. Introductory courses, videos, even AI-powered platforms that offer insights and recommendations.
You remember Equity AI, that tool we talked about before. That's a great example of how AI can help investors.
For sure. Equity AI uses machine learning to analyze huge amounts of data and give personalized recommendations, risk assessments, and portfolio strategies. It's a game changer for investors, both experienced ones and those just starting out.
Sounds like a must-have for navigating these complex markets.
Definitely worth checking out. And as AI in finance keeps evolving, we're going to see even more amazing tools like this. Tools that make financial insights more accessible and empower people to make smarter decisions.
That's a really exciting future to think about. Technology that levels the playing field and gives everyone a chance to participate in the market.
I agree. It's all about democratizing access to financial knowledge and empowering investors.
Well, we've covered a lot today, from volatile markets to the rise of AI. I hope our listeners feel informed and ready to tackle whatever the market throws at them this week.
Me too. It's been an incredible journey through the world of finance. Remember, knowledge is power. The more you know, the better equipped you are to navigate the markets.
Couldn't have said it better myself. Thanks for joining us on this deep dive, everyone. We'll be back soon with another exploration of the trends shaping our financial future. Until then, happy investing.